What's going on, everybody? Listen, the single most important number in any deal you will ever do isn't the price. Believe it or not, it's not the price. It's your cost of capital. And in the last month, one person on earth who controls that number more than anyone else changed. The most people didn't even notice. But if you own a business, if you're trying to buy one, if you're carrying any debt at all, the ground just shifted under your feet. So here's the question that I'm answering today, top to bottom. How does all this change in Washington actually show up in the deals I'm looking at? We're going to the Fed, the SEC, and who's really buying to what's getting done. And then I'm gonna open my own notebook and let you know what's happening in my world of the private equity. All right. Welcome to Money Market Briefs, where we discuss all things private equity, private capital. I am your host, Tariq Collins, and this show is brought to you by the Capital Alliance Network. All right. Don't forget to like, share, subscribe, hit that bell. Please comment. Let us know how we can get better, what episodes or what content you're looking for, how we can connect you, and stay active with our community. Listen. All right, your cost of capital decides which deals work and which ones dies. The cost of capital, basically the interest rate, right? How much is it costing me to get this money? It's the gravity behind every valuation, and the person who sets that gravity for the whole economy has just handed over the key. So before we touch a single deal, you need to know who's driving now. Here's the question. The most powerful seat in all of finances changes hand, and the machine is built to barely move. Why should you, doing deals on Main Street, even care just a little? Why should you even care? Jerome Powell's term as a chair has ended of the Fed of Reserve. Kevin Warsh is now the Fed chair for a 4-year term, and this is a big deal. You recently saw the headlines where Powell and Donald Trump was going back and forth on their views on interest rates, the capital, how Jerome was running the Fed, although Jerome was picked by Trump in his first term and stayed through his first term, stayed through Biden, and it's naturally his selection to be up, which is how Kevin Warsh came into the picture, who was already a Fed chair beforehand. Now, Powell's going to stay on as a temporary as chair pro, right? He's going to be a temporary chair to remain on the governor for a time. So there's continuity on the FOMC, which is the Federal Open Market Committee. That's the group of committee that meets every month, every quarter, every year to decide what's happening in the world, what's happening in the market to determine what interest rates should be. Should we reduce interest rate to open up the markets for people to get capital? Should we put constraints on lending and raise interest rates so people think twice about receiving money so they won't look to loans to slow the economy down based on what's happening from a supply and demand standpoint and an unemployment standpoint? That's what the mandate of the Fed is, right? So Warsh has singled a different posture. He's looking at leaner Fed operations, rethinking balance sheet size, and more focus on productivity adjustment, neutral rate, and changing how the Fed communicates. That's what the mandates that Warsh is looking to do. Now, you assume the story is simple. New chair, rates go up, rates go down. That's what everyone watches. But that's not the real story. The real story is the volatility around the path. A chair who talks differently resets how the whole market guesses the Fed next moves. And the uncertainty reprices risk, and valuation multiplies before a single rate ever moves. The threat to your deal isn't a higher rate. It's knowing which way the wind's blowing the day you sign. That's what it is, right? So the cost of getting into a deal is shifting. But the twist is, at the very same moment, Washington is quietly making it cheaper and easier to get out is coming from one place nobody even expected, the SEC. Crazy. So for 15 years, the rules quietly pushed companies to stay private. They narrowed how you eventually get paid, Basically, sell to a sponsor or strategic in a hope. And if that's reversing, the menu of ways you cash out just got bigger, and a bigger menu means more leverage for you. What does this all mean? The SEC is changing the rules on how we invest and what happens in the public markets versus the private market. So here's a question. If being a public company has been a compliance nightmare for 15 years, what happens to your business the moment the government decides to make it cheap and easy again? If it's been a constraint, what happens when they make it cheaper and easier for you to get in there? Right? So in May 2026, the SEC proposed major reforms to simplify public company reporting and make going and staying public cheaper and more attractive. It would raise the largest accelerator filler threshold from 700 million to 2 billion of public float. A longer, cheaper IPO is on the ramp. It extends scaled disclosures, emerging growth style accommodations to most non-accredited or accelerated fillers, the bulk of the public companies. And it exempts those non-accelerated fillers from auditors and internal controls, a real cut in the compliance costs. Now, this is a big deal because if there's less constraints for companies to go public, meaning it's cheaper and less compliance around what you have to do, what you got to expose, what you got to get into, less reporting for you to go public, which is why a lot of companies choose to stay private, because going public requires you to do so much. It requires you to be able to be accountable to the public, but a part of you being accountable also limits what you do, how you do it, and the ways that you react. Most companies are driving growth based on what the price of the stock market would be so that the companies stay relevant in the stock market and people can continue to believe in them to invest in the stock market. But you also know that it's been less and less companies going public and staying private. So this is another way for the SEC to make the rules a little bit easier for more companies to go public, which now there's more people in your pool of your public markets to be able to invest. They're normal retail investors, your 401ks, your Roth IRAs, your individual stock picking, your option traders, all these guys and girls who are in the markets look for public companies to be able to trade in on the stock market. Well, if these companies got less reporting, right, less constraints, less compliance, it makes it easier for the company to go public. But then on the flip side, what does that do to the retail or institutional investor? Well, I think it gives you a better company because of the longer run rate. What you won't have is so much market manipulation of people who are just trying to do a thing for a headline to drive up valuation or the stock part. So if you drive up the stock price, you drive up the valuation of the company. You drive up the valuation of the company. The psychology says this company is doing great. Let me invest more money into it, which now the valuation to my stock portfolio has increased, right? All based on you trying to hit quarterly earnings for the stock ticker to not drop. But if you're looking at the large pool of your S&P 500, the top 500 companies, it's only about your big 7 or big 7 to 10 companies that's driving the market share of those top 500 companies. So less constraints on going public leads to more companies going public. Now, your instinct is this is just born regulating plumbing, right? Who cares? Where's the reframe? The quiet rewires where deal flow goes. A friendlier IPO path lifts public valuation, creates more public currency and stock for stock deals. And it shifts the whole category of companies from must sell to PE over to maybe we go public. Right. So it's another way for a company to exit. Maybe they don't sell to PE for them to get a return or for them to get a buyout of their firm. They go public for the public market to be able to infuse cash, for the company to grow and for the owners and the founders to get a buyout on the company that they started, right? So the pendulum that drove everything toward private for 15 years is starting to swing back for the changes that's happening with the SEC chair under this administration. So the doors in and out are both moving, which raises the real question: who actually shows up with the checkbook now? And the answer is kind of a buyer that used to stay completely invisible and now is behaving like a private equity firm of its own. That's what's going on, right? So the SEC is making moves. The Fed chair is coming in with a redesign on how they're looking at the Fed, which lowers the interest rate, which makes lending more accessible and easy to get access to. And now with the SEC changing rules for companies to go public with less compliance, now you got more companies going public on the stock market. And we just heard of two big giants that are going public between SpaceX and Anthropic. These two companies that are taking and putting their S1s to go and file their initial offering is happening already as we speak, right? So the things here is simple. People you're competing against or could partner with to buy a business are changing. And if a family office is the one setting across the table, the entire math of that auction changes. Now you got family offices entering the chat of the private markets, right? So what's a family office, right? And this is the happenings of what's going on across the M&A environment in the world, across everything. So we just covered the SEC, the Fed chair that came in, now we're on the family offices. Family offices are established to basically preserve family wealth and money. So a good example would be one that everybody knows, Chick-fil-A. It's the family-owned, privately held company, Chick-fil-A company, that's have revenues in the billions, right? They would have a family office that oversees their wealth to preserve it. That's the number one mandate of a family office, which means in the ways that we preserve wealth, we're not necessarily aggressive in investments to make money, but we're conservative in a way that lets our money last from one generation to the next. That's what they're preserving. So typically a family office would be majority of their wealth is in the public market, stock market, so they're buying public companies. They allocate a small, somewhere between 10 and 20% into alternative assets. So that will be your private equity, your private credit, any alts, real estate that they're directly lending towards of their capital, the difference of what's going in the public markets. So most private credit or private equity firms will raise dollars from your family offices and other institutions to go into their fund. Their fund then deploys the capital. They get hit with the management fees, etc. But now what's happening is family offices is deciding to, some of them are deciding to not invest in private equity from a traditional fund standpoint. And what they're doing is direct lending into the businesses that they want to invest. So what happens to a deal when a bidder across from you isn't a fund with a 5-year clock to LPs to answer, but a family that can hold forever and answer to no one? And that's what happened in the private markets. The family office is coming in and being able to directly invest into a company, which means the way you grow the company changes. The psychology of it changes. In a traditional fund, if I raise a fund, $100 million fund, I'm looking to deploy capital for 5 years, right? Anywhere between 5 to 7 years. So the first 3 to 4 years, I'm deploying capital, buying up as many companies as we possibly can, growing the companies, adding value to these companies from an operational standpoint, an employer standpoint, everything that we need to do to grow these companies from A to get them to B. The last half of those years, I'm looking to sell so that we can give a return on investment to our LPs, are people who invested into this fund. So now that we bought these companies, we done did the roll-ups, we done did executed on the strategy. These companies are doing very, very good. Now we're trying to exit. And so the way that we're exiting is the normal ways everybody else is going to exit. Either we're going to sell to a bigger PE firm who can take this company and go and grow at it from a bigger perspective, right? Or we're going to sell it to a strategic buyer, or we're going to be the reason that this company goes public on the public stock market so that we can get our return on investment. The constraint is smaller and the window is tighter because you literally only have 5 years or so to buy a company, change a company, drive up the valuation of the company, and then sell the company so you can make more money than what you paid for the company in to begin with, and do a return on investment and to redo another fund. Does that make sense? So with that being said, the constraints is normally tighter. Here's where private equity gets its bad name from. All private equity come in and do is come in, they buy up the company, they strip the company of its employees, they fire people, they take out the goodness of a company and just strip it away from parts for the money. If the business fails, like Toys R Us, they blame the private equity firm KKR because it's now backed by private equity, and these are the reasons why it busts, not knowing that there's other intricate and rules that go into it, but that's where they get their name from. What family offices are now doing is they're coming in and say, hey, we're going to be the strategic investor. And because the family office mandate is to preserve capital and wealth, not to necessarily have a return on investment that's so significant where they're hedging a riskier bet, they have time for businesses to grow. So they're in it for the long-term gain. Think Warren Buffett long-term investment versus private equity short-term gain, because we need our money to last generation. I got to go from my generation to my kids, to my grandkids, to their kids, to their kids, to their kids. So I want a company that I can stay with, that's going to be able to, I can grow with this company. They can grow with me. We can provide capital. We can provide resources. And there's a longer runway for us to make, value change versus a short window for us to hurry up and sell it. Right. And that's what's happening. So JP Morgan Global Family Office report says that the average target return in the low double digits is around 11%, and roughly the mid 40% of portfolios are in alternatives, PE, real estate, VC, hedge funds of family offices, right? So they put about 40% of their capital into these spaces. A growing focus on AI opportunities, inflation protection, and geopolitical risk, families lean into direct deals and co-investments instead of only going through funds. So because of all the market headlines of AI and inflation, they're trying to protect and be more conservative and directly invest for a longer span, right? Now, most people hear family office and picture slower, softer, less competitive money, but it's the opposite. Their lack of fund clock is the superpower, and that's what you really want. If you're a business owner, you want to try to lean into the family office because they can lock in with you and stay in there, right? They can pay up, they offer, and it's probably less politics on you getting funding because you're directly dealing with the fund manager that's directly involved with the family, who can give you a direct yes or no, versus all these intermediaries that you're dealing with for you to get a yes from a big fund, from the investment committee. Same could be said for those that are raising dollars too. Your family offices will probably be available for different types of negotiation of how you want to do your fund. Right. They offer a cleaner, more flexible terms. They hold for decades. They skip the intermediaries entirely. In succession deals, the niche verticals, they're often the ones outbidding the traditional sponsor. That friendly capital that can quietly be the most dangerous competitor in the room, right? And so that's the thing that you want to be able to see. So the shift of cost of capital, wider exit options, a brand new kind of buyer at the table, put all three together, and it changes what actually gets done out there and into the deal floor. So what's happening on the deal floor? What's going on the grounds of the everyday deals, right? So because we established that the Fed chair has changed, the communication rules will be different. So the Fed will be able to probably lower interest rate or predict what happens based on how they're going to communicate with Kevin Warsh. The SEC is opening it up for us to be able to go public, right? And family offices is stepping in the picture as another funder or rounder or be able to be a strategic partner. This segment is where we're going to get into what's happening on the deal-to-deal basis on high-quality assets, right? Being the one that's right next door. So, in the market, this selective, what makes one business spark a bidding war while one next door gets total silence? And the answer is volume is recovering, but selectiveness, high quality assets in resilient sectors still clear a strong multiple. Marginal asset struggles to get bids. More earnouts and seller roll equity to bridge valuation gaps. Tighter finances are more conservative leverages, right? The mixes are the M&A to fill their product or tech gap, family offices, independent sponsors showing up more in the sub $250 million deals and lower leverage. The hold is there. So what's happening there? You want to go after these boring businesses. It's the boring businesses, this everyday cash flowing that allows these investors to diversify their book to where they're not heavily into AI or not heavily concentrated in one sector or another, right? So now let's assume there's a soft M&A market means everything is cheap and slow. That's the wrong frame, right? Isn't it a slow market? It's a sorting market. The gap between what a clean, resilient, reoccurring revenue business fetches and what marginal one fetches has never been wider. Buyers aren't paying less, they're paying up for quality and walking away from everything else. These guys and girls are looking for the quality businesses, not the headline news and noise that you see every day. So the question was never buyer market or seller market. It's which side of the quality line you're standing on. So that's what's happening in the markets today from a sorting standpoint. You want to see what out there can be funded and who you want to be strategic in raising capital from and where you want to deploy your capital. You really for you to win, you really want to stay away from the big headlines. If I'm you and you're me, you'll be following what my playbook and my strategy is, and we're going to get into that right now. Right? So everybody's out there reacting to headlines. Almost nobody has a thesis that's the whole difference between investor and a gambler, right? A gambler chases whatever's hot. An investor has a written down belief about where the value actually gets built, and the discipline sits on their hands until a deal fits it, which means we're not buying stuff just to buy it. We're waiting on the right deal, the right opportunity, at the right moment, at the right time to get in and be able to make an impact of everything that's going on. So the things that you have to kind of sit with and ask yourself is, what do I actually believe about where wealth gets built in the private market? And how do I make sure I deploy capital when the deal fits that belief and not my emotions? So the way I run my firm is we're running a principle-driven investment firm where we acquire established cash-generating small to mid-sized business, the unglamorous, the profitable backbone of America. Instead of flipping them, I'm doing roll-ups on these businesses, which means that we're going for boring businesses, to be simply put. Boring, everyday, cash-flowing businesses. These are your cleaners. These are your HVAC. These are your plumbing. These are your electrical businesses. These are the things that builds infrastructure. These are the things that the big headlines are pushing, but the subsidiary businesses can support. For instance, data centers are being built up all over the place to support the AI. Well, part of the data centers being built, that's infrastructures that's needed. Concrete and paving company, electricians, plumbing, all these things factor in how data centers are being built in these communities, right? Which are business opportunities for you to buy into these everyday cash flowing businesses. These are businesses that's going to withstand AI or with AI can improve and enhance its services, not get wiped out because of AI. And that's where my thesis is built around in my firm. And we're building that up from the ground up. And we're going after the everyday, non-sexy. I'm not even looking at tech unless tech can help enhance our businesses to the next level. So that's where you invest in things that's generating Cash flow, has a defensible niche, a moat, right? Has sticky revenue, recurring revenue, low customer concentration, meaning that you don't have a big turnover on how many clients come in and where they go. Often these businesses are owners that don't have a succession plan, or their succession plan is to sell, but they don't want to do it to the big PE firms, and they're looking for the buyer who's going to take care of their baby, their business, right? We're looking for the multiples. We don't want to overpay for a business, and we don't want to cut the business either, right? So we want to make sure that we're buying at the right market, and it's a business that when we buy it after we close, that we can professionalize the operation, add modest tuck-ins to the acquisition, build a durable cash flow. Value creation is the most important out of all these. Can we have operators that actually improve the value of this business? Not just doing financial engineering, but actually growing the business. And that's going to be the key differentiator between some of these big PE firms and some of these guys and girls like you and I who are starting our firms, who have been operators and investors. That's the different outlook that you want to look, right? And you want to hold some for long term. The way I'm building my firm is some of the businesses we have we'll keep for us to have permanent internal capital, in addition to raising a fund for us to do the fix and flips of the business, the roll-ups of the business, and give a return on investment to our LPs. You need that. And we need a diversified firm where we can collect income and fees and have income generating things from multiple sources. And not just pigeonholed to a fund itself. And that's how I'm running my firm. And we got a few deals on the table. I'll let you guys know about that more and more as you guys get to know me. I get to know you as we continue on with this show. So everybody's chasing like the next tech unicorn that's 30 times in revenue. But my thesis says, listen, real repeatable wealth is sitting in the boring stuff. Right. It's not to, sugarcoat or, for lack of a better term, shit on the tech companies or those guys and girls that's doing good. I think if you understand it, if you understand the business model, you understand the risk, go for it. The thing that I'm thinking about is I'm thinking about the repeatable businesses, the boring stuff, the things that businesses are profiting from, service firms, the clinics, regional operators whose owners retiring with no one to take over. We're going to buy it at 3 to 5 times the earnings, and we're going to be able to sell, if we sell, for a higher multiple. But those are the alpha companies out there to me, and that's what you want to look at. All right, guys, so listen, that's the whole stack, man. We talked about the Fed, the gravity, the SEC widening on exit, family offices just changing who's bidding on the deals. I told you about what I got going on into my firm, how we're growing and what we're doing. And that's the wrap of today's episode. We're going to continue to come back every Monday with different market briefs to make sure and ensure that you got the latest news of the private markets. Don't forget to like, share, subscribe, and I'll see you next week, same time, same place. Peace.